The Standard & Poor's 500 index fell into correction territory on October 26th by dropping more than 10% from its all-time high 5 weeks earlier. Looking at the last 6 decades of modern history shows that recessions triggered bear markets, but not every recession was accompanied by a bear market. Bear market drops of 20% or more occurred during economic expansions, but most bear markets coincided with recessions. Corrections of 10 or even 15% on swings in investor sentiment are not uncommon during bull markets. The current bull market was marked by 4 corrections before the most recent one. What caused it? Earnings expectations. The average earning growth rate of 7.7% on the S&P 500 over the decades drove stock prices higher at an average annual rate of 7.7%. Wall Street's expectations for 2018 and 2019 earnings growth are well ahead of historical growth, which drove the market's gains in recent months. With 2018 nearly over now, Wall Street's analysts' expectations for 11% profit growth in 2019 are now a focus and may need to be revised lower. At 112 months old, this is the longest bull market in modern U.S. history, and corrections can be unnerving. While no one can predict the market, the economy remains strong. The economy grew by 3.5% in the third quarter of 2018, the second best quarterly GDP growth rate in the past 16 quarters, and it was in line with expectations. Economists surveyed by the Wall Street Journal in early October predicted GDP growth would grow in the third quarter by 3.4% and an average quarterly GDP growth rate over the 5 quarters ahead of 2.7%. Moreover, expecting a slower rate of earnings growth in 2019 is not at all the same as expecting a decline in earnings. The economy is growing, and it's wise to think of stock market corrections as part of your long-term investment plan.